Have you ever wondered why gold and silver sometimes make their biggest moves when nothing seems to be happening in the metals market itself? The answer is simple. Precious metals don't move because of headlines alone. They move because of confidence, fear, economic expectations, and the decisions made by governments and central banks around the world. And right now, we are entering one of the most important moments for financial markets this month. In the last 24 hours, three major developments have captured investors' attention. China has released trade data that shocked economists. The United States is preparing for one of the most closely watched jobs reports of the year, and traders across the globe are repositioning their portfolios ahead of what could become a defining moment for the Federal Reserve's next move. If you own gold, silver, mining stocks, or even US dollars, today's discussion could help you understand where the market may be heading next. Welcome back to Macro Bullion. I'm Alex James, and as always, my goal is not to tell you what to buy or sell, but to break down the latest macroeconomic developments using verified facts and logical analysis. Every statistic discussed in today's video comes from recently released economic reports and reputable financial news sources, while the opinions and market outlook are my own independent analysis based on those facts. Let's begin with the biggest international story because it arrived from China and immediately caught the attention of global investors. According to the latest official trade data, China's exports surged by approximately 23% year over year in July, significantly outperforming market expectations. This was one of the strongest export performances seen in recent months and immediately challenged the narrative that global trade is slowing dramatically. Despite ongoing tariff disputes, geopolitical tensions, and concerns about weakening international demand, Chinese manufacturers managed to sell far more goods overseas than economists had predicted. At first glance, this appears to be an extremely bullish signal for the global economy. Higher exports usually mean factories are producing more, supply chains remain active, shipping volumes increase, and demand from international buyers remains healthy. Since China is the world's largest manufacturing hub, stronger export activity often improves confidence across commodity markets, industrial metals, shipping companies, and emerging economies that depend on global trade. However, experienced investors know that one number never tells the complete story. While exports recorded an impressive jump, China's imports expanded at a much slower pace. This resulted in another large trade surplus. On one hand, a wider trade surplus reflects strong competitiveness in manufacturing and export industries. On the other hand, relatively weaker import growth raises important questions about domestic demand inside China. If households and businesses are not increasing purchases at the same pace, it suggests that parts of the Chinese economy are still recovering unevenly despite strong external demand. This distinction matters because China's economy influences almost every commodity market in the world. Whether we are talking about copper, iron ore, oil, or silver, China remains one of the largest consumers of raw materials. When Chinese factories increase production, industrial demand for metals generally improves. But when domestic activity slows, commodity demand can lose momentum despite healthy exports. That is why investors should avoid celebrating one data point without examining the broader economic picture. Silver investors in particular should pay close attention to these developments. Unlike gold, which is primarily considered a monetary asset and a safe haven investment, silver has a dual identity. It is both a precious metal and a vital industrial metal. It plays an essential role in solar panels, electric vehicles, semiconductors, medical equipment, telecommunications, artificial intelligence infrastructure, and advanced electronics. Every expansion in manufacturing activity has the potential to influence physical silver demand. China's latest trade report therefore carries important implications for silver. Strong export growth suggests factories continue operating at relatively high capacity, which supports industrial consumption of silver across multiple sectors. But the slower pace of imports reminds investors that China's domestic economy has not fully regained its previous strength. In other words, the latest data is encouraging, but it does not yet confirm a broad-based economic recovery. While markets were still digesting these numbers from Beijing, attention quickly shifted across the Pacific to another event with the power to move every major financial asset within minutes. Investors are now waiting for the United States July non-farm payrolls report, a release that could redefine expectations for interest rates, the US dollar, treasury yields, and ultimately the next major move in gold and silver. That is where the story becomes even more interesting, because what happens in Washington may ultimately determine whether China's positive trade surprise becomes the beginning of a larger global recovery, or simply another temporary headline. One of the biggest questions every silver investor is asking today is very simple. Why did silver pull back pullback after touching recent highs, even though the long-term outlook still looks extremely bullish? The answer is not that demand has suddenly disappeared. Instead, the market has entered a temporary waiting phase. According to the latest Shanghai Metals Market commentary, silver prices eased from recent highs as traders reduced positions ahead of the U.S. non-farm payrolls report. This is something we have seen many times before. Before a major economic release, institutional investors prefer to protect profits rather than take unnecessary risks. It doesn't necessarily mean the bullish trend has ended. More often than not, it simply means the market is waiting for fresh direction. This is where many retail investors make a costly mistake. They see a short-term decline and immediately assume that the rally is over. Professional investors think differently. They ask one important question: has the fundamental story changed? At this moment, the answer appears to be no. The recent pullback has been driven more by positioning and caution than by any major deterioration in silver fundamentals. In fact, several respected market analysts continue to believe that silver's long-term outlook remains constructive. One of the strongest opinions came from Market Gage's Michelle Schneider, who recently explained that gold's powerful rally is not simply about inflation or interest rates. According to her analysis, the rally reflects something much deeper: a growing lack of investor confidence in the global financial system. When confidence begins to weaken, investors naturally search for assets that have preserved wealth throughout history. Gold has traditionally been the first destination, but once confidence continues to deteriorate, silver often begins attracting attention because it combines monetary value with industrial demand. That distinction is extremely important. Gold is primarily a store of value, while silver has two powerful engines driving its price. The first is investment demand, which usually increases during periods of economic uncertainty. The second is industrial demand, which depends on manufacturing, technology, renewable energy, and advanced electronics. When both of these drivers begin moving in the same direction, silver has historically delivered stronger percentage gains than gold. This is one reason why many experienced investors are watching silver more closely than ever before. Even after the recent correction, the broader story has not changed. Governments continue investing heavily in renewable energy. Artificial intelligence infrastructure is expanding rapidly. Data centers require enormous amounts of electrical equipment. Electric vehicles continue to increase silver consumption, while advanced semiconductor manufacturing depends on high-quality conductive materials, where silver remains one of the best available metals. Another important development comes directly from the mining industry. Sunshine Silver CEO recently stated that the industry is entering what he described as our time. His confidence is based on one simple reality: industrial demand is expanding much faster than many mining companies can increase production. Bringing a new silver mine into operation is not a process that happens overnight. Exploration, permitting, financing, environmental approvals, and construction often require many years. That means if demand continues accelerating because of AI, electrification, and clean energy investment, supply could struggle to keep pace. This is exactly why the next few days are so important. In the short term, silver may continue reacting to the U.S. jobs report, treasury yields, and the U.S. dollar. But beyond those daily fluctuations, investors should not lose sight of the much bigger picture. Temporary volatility can create opportunities, but the long-term direction will ultimately depend on whether industrial demand continues growing while investment demand remains strong. If both forces continue supporting the market, silver could be setting the foundation for its next major move. One of the reasons I remain focused on silver is because the market is no longer being driven by just one story. A few years ago, silver investors mainly watched inflation, the US dollar, and Federal Reserve policy. Today, the market has become much more complex. Silver now sits at the center of two powerful global trends. On one side, it remains a traditional safe haven asset that benefits when investors lose confidence in the financial system. On the other side, it has become an essential industrial metal powering the technologies that will shape the next decade. When these two forces begin working together, silver has historically delivered some of its strongest rallies. This is exactly why Market Gage's Michelle Schneider believes investors should not look at gold's rally in isolation. Her argument is that gold is rising because confidence in traditional financial markets is gradually weakening. Investors are becoming more cautious about government debt, persistent inflation, economic uncertainty, and the long-term outlook for global growth. Gold is usually the first destination during these periods because it has been recognized as a store of value for centuries. But history also shows that once confidence continues to shift and fresh capital enters the precious metals sector, silver often begins catching up at a much faster pace. The reason is simple. Silver has a much smaller market than gold. That means it takes far less investment capital to create larger percentage price movements. When institutional investors, hedge funds, and retail investors start increasing exposure to silver at the same time, price momentum can accelerate very quickly. This is why silver has earned the reputation of being one of the most volatile precious metals. Volatility works in both directions, but during strong bull markets, it has often allowed silver to outperform gold. At the same time, silver's industrial story is becoming stronger every year. The world is investing billions of dollars into artificial intelligence infrastructure, cloud computing, high-performance data centers, renewable energy, electric vehicles, and next-generation electronics. These industries all have one thing in common. They require highly conductive materials, and silver remains the best natural electrical conductor available. Whether it is solar panels converting sunlight into electricity, AI servers handling massive computing workloads, or advanced semiconductor manufacturing, silver continues to play a critical role. That is why the recent comments from the CEO of Sunshine Silver deserve attention. He believes the silver mining industry is entering a new phase where demand growth could begin outpacing future supply. His optimism is not based on short-term price speculation, but on long-term industrial consumption. The challenge for mining companies is that increasing production is not easy. Developing a new mine can take many years, requiring exploration, environmental approvals, financing, infrastructure, and construction before a single ounce reaches the market. If industrial demand keeps accelerating while mine supply grows slowly, the supply-demand balance could tighten significantly over time. This supply challenge becomes even more important when we remember that a large portion of global silver production comes as a byproduct of mining for other metals such as copper, lead, and zinc. That means silver output does not always increase simply because silver prices rise. Production often depends on activity in completely different mining sectors. This creates a structural limitation that many new investors overlook. For now, the market remains cautious because traders are waiting for the latest U.S. economic data before making aggressive positions. Short-term price fluctuations are completely normal, especially ahead of major events like the non-farm payrolls report. However, when we step beyond the daily headlines and examine the bigger picture, the long-term fundamentals supporting silver appear far stronger than they did just a few years ago. The combination of growing industrial demand, constrained mine supply, and increasing investor interest is creating a foundation that every serious silver investor should continue watching very closely. The most important thing silver investors need to understand right now is that markets often move before the majority of investors recognize the change. By the time the headlines become extremely positive and everyone starts talking about a major opportunity, a large part of the move may already have happened. This is why professional investors focus on fundamentals, supply-demand dynamics, and macroeconomic trends instead of simply following daily price movements. Silver is currently developing a unique investment story because several major forces are coming together at the same time. The first force is declining confidence in traditional financial assets. The second is increasing industrial demand from technology-driven sectors. The third is the challenge of expanding silver supply. When these three factors combine, they create a market environment where even small changes in demand can have a significant impact on price. Let's look deeper at the industrial side because this is where silver separates itself from gold. The global economy is moving toward electrification and advanced technology. Solar energy installations continue expanding worldwide, electric vehicles require more electronic components, and artificial intelligence is creating demand for massive data centers and advanced computing systems. Every one of these industries requires silver. Artificial intelligence in particular has become a new factor in the silver market discussion. The AI revolution is not only about software and algorithms. Behind every AI system is physical infrastructure, servers, power systems, networking equipment, and advanced electronics. These technologies require highly reliable electrical connections, and silver's unique properties make it extremely valuable for these applications. However, the market faces a challenge that cannot be solved quickly. Demand can increase rapidly, but supply cannot respond overnight. Unlike financial assets that can be created instantly, physical silver requires exploration, mining, refining, and transportation. Even when prices rise significantly, mining companies cannot immediately double production. This supply limitation is one reason why silver markets can experience sudden price movements when demand increases faster than expected. Yet, another factor that investors should monitor is the relationship between gold and silver. The gold-silver ratio, which measures how many ounces of silver are required to buy 1 ounce of gold, is often used by investors as a valuation indicator. Historically, when the ratio becomes extremely high, some investors believe silver may have stronger upside potential because it appears undervalued compared with gold. However, this ratio should never be viewed as a guaranteed prediction tool. It is simply one factor that helps investors understand relative market conditions. Right now, gold has been leading the precious metals sector because investors are concerned about economic uncertainty, inflation risks, government debt levels, and geopolitical tensions. But if confidence continues shifting toward precious metals and industrial demand remains strong, silver could potentially enter a phase where it begins closing the performance gap with gold. This is why the next major moves in silver may not come from silver news alone. They may come from broader economic developments. A weaker US dollar, falling interest rates, increased investor demand for hard assets, or stronger global manufacturing activity could all provide additional support. On the other hand, a stronger dollar, higher bond yields, or a significant slowdown in global growth could create temporary pressure. The key word here is temporary. Investors should separate short-term volatility from long-term trends. A price correction does not automatically mean the fundamental story has changed. In many historical bull markets, strong assets experience multiple pullbacks before reaching new highs. The challenge is having enough understanding to identify whether a decline represents a fundamental breakdown or simply normal market behavior. For silver, the evidence currently points toward a market facing growing demand, limited supply flexibility, and increasing attention from investors. But patience remains essential. The strongest opportunities are usually created when markets are uncertain and emotions are high. The investors who succeed are often those who prepare before the crowd arrives, not those who follow after the excitement begins. The silver market is entering a period where patience, discipline, and a deep understanding of global economic forces will become more important than ever. The story of silver is not simply about a price chart moving higher or lower on any given day. It is about a much bigger transformation taking place across the global economy. The world is demanding more technology, more energy infrastructure, and more advanced manufacturing than ever before, and silver remains one of the critical materials supporting that transformation. When we connect all the pieces together, the picture becomes much clearer. Gold's recent strength reflects growing investor concerns about financial uncertainty and confidence in traditional markets. Investors are looking for protection against inflation risks, currency concerns, and economic instability. But silver offers something different. It provides exposure not only to the same monetary forces that support gold, but also to the industrial revolution happening around the world. This combination is what makes silver unique. The latest comments from analysts and mining executives highlight an important reality. The future demand story for silver continues to expand. Artificial intelligence, renewable energy, electric vehicles, advanced electronics, and global electrification are not temporary trends. These are long-term changes that could continue influencing silver consumption for years. However, investors must also remain realistic. A strong fundamental story does not mean prices move upward every single day. Markets move in cycles. Silver can experience sharp rallies followed by corrections, periods of consolidation, and sudden volatility. These movements are normal because silver is a smaller and more reactive market compared with gold. Understanding this volatility is essential for anyone following the sector. The short-term direction will likely continue to depend on several key factors. Federal Reserve policy remains one of the biggest influences. If inflation continues cooling and the market begins expecting easier monetary conditions, lower interest rates could weaken the dollar and create a more supportive environment for precious metals. A weaker dollar generally makes gold and silver more attractive for international buyers because they become less expensive in other currencies. The global manufacturing cycle will also remain extremely important. China's strong export performance has shown that parts of global demand remain healthier than many expected. If manufacturing activity continues improving, industrial silver demand could receive additional support. At the same time, investors should continue monitoring China's domestic economy because sustainable growth requires both strong exports and stronger internal consumption. From my perspective as an independent macro analyst, the silver market represents one of the most interesting opportunities within the commodities sector, but successful investing requires separating excitement from evidence. The strongest investors are not the ones who react emotionally to every price movement. They are the ones who understand the forces driving the market and prepare accordingly. Right now, the silver story is being built by three major themes: increasing industrial demand, limited supply growth, and renewed investor interest in physical assets. If these three forces continue developing together, silver could remain one of the most closely watched markets in the years ahead. But remember, every investment decision requires personal research, risk management, and a clear understanding of your own financial situation. Market conditions can change, new data can alter expectations, and no analysis can guarantee future results. If you found this deep analysis valuable, make sure to subscribe to Macro Bullion for more independent coverage of gold, silver, global economics, Federal Reserve policy, and the major trends shaping financial markets. Share your thoughts in the comments. Do you believe silver is entering a new industrial supercycle, or will economic uncertainty continue driving investors primarily toward gold? Your opinion matters because the biggest market discussions are built through different perspectives, and before making any financial decision, always verify the latest market data, review multiple sources, understand the risks involved, and remember to do your own research, DYOR.